As we begin 2015, stocks remain near record highs and the economy is expanding, but what should investors be watching on the economic front in the new year, especially with the Federal Reserve expected to make its first rate hike since 2006 at some point in 2015? Let's bring in Bob Johnson, Director of Economic Analysis at Morningstar, joining us from Chicago. And Bob, let's begin with the Fed. Do you see them tightening in 2015, and if so, when?
You know what? I think the Fed probably will tighten sometime in 2015. You know, rates have been abnormally low, and I think rates need to at least be a slight premium to what the inflation rate is. And so I think they've been abnormally low. They will at some point during the year start to bring them back towards a more normal level where you get a little bit of a premium over inflation. So I think we probably will have a move, especially with the U.S. economy improving. That said, I don't think it's the most relevant piece of economic data. The Fed has not been very helpful in helping us predict things in 2014. We economists generally got the Fed and what they were going to do in 2014 exactly right, namely ending the tapering program, talking about increasing rates and so forth. It's exactly what we got, and we thought rates would be up 1% in 2014. Instead, the 10-year rate was down 1%. So I'd be a little careful of following the Fed too closely because it may not be the most relevant benchmark anymore.
Well, let's talk about inflation. That's been on the decline due to low gas prices. Now, you see inflation for 2015 between 1.8% and 2%. Do you think that's a pretty high estimate given how low gas prices are?
Sure. I think one of the things to keep in mind is that right now here as we ended the year, I think we're pretty close to the bottom in gasoline prices. They may go down just a little bit more, but then I think long-term supply and demand in the oil industry are relatively close. And I think prices, I don't think they're going to boom back up, but I think we've probably seen close to the low, and prices will generally go up on oil in 2015, and that will pull up the inflation rate a little bit. And I think we'll see that 1.8 to 2% rate, which is actually quite an acceleration from the 1% rate that we'll probably end up with in 2014.
And could that delay a rate hike, an inflation rate so close to the Fed's target?
It could. I mean, with inflation being so low, you know, the Fed's mandate is one, help employment, and two, to keep inflation under control. And certainly if inflation appears to be under good control, that may hold them back a little. Although I'd caution them if it's, you know, just because oil prices are low, that maybe they shouldn't wait too long to raise rates,
right. Because
once the door is open, we can be really stuck and it's hard for them to catch up.
All right, what about GDP? We had quite an impressive GDP report last week, which showed third quarter GDP at 5%. We'll have another reading later this month, but where do you see GDP in 2015?
Well, let's separate the two. First of all, in 2014, which will be the first piece of data that we see at the end of the month, will be for the fourth quarter of 2014, and I think the growth rate will probably go in half. If we had 5% in the third quarter, I think something more like 2.5% looks much more likely in the fourth quarter. And we had a kind of an unusual series of events that really helped the third quarter, and the 2.5% that I see for the fourth quarter is still a nice rate. And then looking ahead to 2015, I think we'll be in that 2% to 2.5% range for all of 2015, the same as we've been, frankly, for the last 3 years. I think the consumer will do better in 2015 than they have in some time. Exports will look worse. Housing will be relatively flat. So that I think we're going to stay in that same 2 to 2.5% range, which I think is probably well below the consensus thinking that we'll grow 3% or more in 2015.
All right, let's talk real quick about housing. We saw a steady deceleration in home prices throughout 2014, but do you see some sort of a rebound in 2015 in terms of prices?
Okay, in terms of pricing, no. I think we're going to be relatively stable where we're at. The consensus is for home prices to grow about 3.5% in 2015 versus 4.5% in 2014, and probably something in the 8 to 10% range in 2013. So we've had a kind of decelerating pattern. And frankly, because incomes aren't growing real fast and the demand numbers haven't been so great lately, I really don't see much home price increases in the year ahead. I think we're going to be pretty modest. I think that 3.5% might be just a little low, but 4% I think is the best we can hope for in the housing market in terms of prices next year. Now, I think we'll begin to pick up next year, both in terms of housing starts, which I expect to be up about 10% next year to about 1.1 million, And I also expect existing home sales, which were shockingly down in 2014. We actually sold fewer homes in 2014 than 2013. I think next year we'll have probably a 5–6% increase in existing home sales. So a little bit faster on starts,
Right.
a little bit slower than that in existing, but prices being lower than all the other two.
All right, Bob Johnson, Director of Economic Analysis at Morningstar. Thanks for joining us.
Thank you for having me today.
I'm Scott Gamm, and you're watching The Street.